Are you like some of my friends, small business owner that's managing their business without books, without accounting, kind of thinking that's just a tax thing? Well, there's some easy ways to get started and can have a big impact on the way you manage your business. I'm Kareem El Gamal, and today I'll give you some basic pointers on how to get started with your first P&L. P&L, that's P and L for profit and loss statement. The profit and loss statement is really exactly what it sounds like, is understanding if you're making a profit or a loss. Do you know if you're making a profit or a loss? Are you just counting, looking at your bank statement at the end of the day and just saying, hey, I got money in the bank, I made money this month. I don't have money in the bank, I lost money this month. None of that is really true, a good check of your health, like you would know if you had an actual profit and loss statement. The first way to get started with that is understanding the three components. I would break it down in the top line, which is if you had a spreadsheet. Ew, scary word, spreadsheet. Do it on whatever you want, okay? Excel is probably the easiest way to get started. You got your top line, your revenue, how much came into the business. Then you've got the middle part, all your expenses, okay? Your main expenses, food, ingredients, right? Drinks, bottles, cans, the stuff that you're gonna sell to the customer. Then the next part of your expenses are going to be things like your rent, your electricity bill, okay? Your paper goods that you're gonna package your food in. All kinds of random small expenses, legal expenses, maybe even like the subscription to your YouTube channel. Then the third part, the part that really matters, your bottom line, the net income, net. You got gross is the big number, you take away your expenses and you're left with something in your net. Did you make money or did you lose money? That's the three basic components. Let's get into it a little bit more. How could you get started with whatever you have? I don't know what you're looking at. You know, back in the day, restaurant owners, they looked at their cash drawer. Today, everyone's running their business with cards. And if you're like most restaurants, you're probably at about 85 to 90% credit debit card use, very little cash. So that doesn't even matter anymore. You gotta look at your POS system, if you have one, or your receipt report, and understand how much money came in. Let's start off with a monthly P&L. Start with seeing your 30 days in a calendar or your 28 days if you want to do 4 weeks. The way we do in our business, we have 13 4-week periods, and that adds up to the 52 weeks of the year. Just so that every period, okay, you can call them months, but their periods are exactly the same number of days. It helps me figure out, you know, am I up or down this month? Because it's just the same number of Fridays, same number of Saturdays, and so on. Take your month, you add up all the revenue that you made, okay? And now we gotta start figuring out your main expenses. Group them into 3 expenses, okay? Take every single money that left your business and figure out, was it a food and drink expense? We're gonna call those COGS, cost of goods sold. Put everything related to the food you sold into that category. You want to put the cup that you sold your drink in, put it in there, I don't care. Let's start somewhere, but be consistent. Second group is your labor, okay? Your payroll. How do you pay your employees? Do you pay yourself for the job that you do? You should, okay? Because if basically you're doing the role of a manager and you want to understand the health of your business. So anything related to payroll, okay? Whether you're paying them wages, whether you're paying them salaries, you're paying them daily, paying them monthly, whatever it is, figure out what you gotta do to put it into that category. Are you giving benefits? Put it in there, okay? Anything that you think is really worth the people, put it under the payroll category. The third one is called overheads. That's everything else. So if it didn't make in the first 2 buckets, put it into that bucket. Is it your rent? Like I said earlier, is it your rent? Is it your electricity bill? Do you have some kind of legal accounting fees that you do regularly? Anything that's going on every day, every month in your business, put it into that bucket. Then take that top number and subtract everything else from that and see what you have at the bottom. That is your first assignment of getting your first profit and loss statement. All right, we went over the basics of the basics, and if you're still listening, I'm happy to dive in a little bit deeper. What's the point of all this? How are you gonna manage your business with a P&L, okay? What's the point? I'm obsessed with hospitality, with good food, restaurants, entertainment, okay? I love that stuff, I'm passionate about it. But at the end of the day, I can't continue to do that passion if I am not in a sustainable business position. It's the sad truth. At some point, the business is gonna matter, okay? And this is what I'm here to help you through. And let's just say, I'm gonna use round numbers to make things easy to follow, okay? Let's just say, in every example I use, the restaurant or your small business makes $1 million in revenue. What does 1% mean? 1% is $10,000. If you can save 1% on whatever you're doing, you're gonna get to walk home with $10,000 more in your business to invest in marketing. Maybe add an addition to your house. Hire that employee that you needed to answer the phone on Friday nights or on Monday nights. I get it, we're all there. So the whole point is, when you've got business and good business practices, you get to do more of what you like. That's why it matters. You've got to answer that question to yourself every time you find yourself wondering, oh, why am I doing this? Or like, it's okay, I'll figure it out. Maybe you will, maybe you will. Maybe you will be lucky enough to make enough to just keep doing what you're doing. Maybe this isn't for you. But if you're like everyone else, we always want to do more things, and we're held back a lot of times by money. And if you're not held back by money because you're borrowing it, that's a bigger reason you have to understand your basic finance. 1%, right? $10,000. You're like, it's $10,000, I'm making $1 million. You are not making $1 million. If you're like the average restaurant in America, you make 5%, you make $50,000. That is after paying yourself, by the way. If you're making less than 5% before you pay yourself, that's your money, your salary, well, you've got to fix your restaurant. So let's talk about that P&L. If you can take your restaurant from 5% to 6%, that is, for you math heads out there, a 20% increase. Now we're talking. We're not talking about a 1%. We're talking about 20% more than you made last year. How do you find that 1%? You have to know your costs. It's hard to say, I'm gonna save, $1,000 every month. How are you gonna save it? Where? Like, you can, maybe you can, cut someone's hours and they're 1,000, but now you're dealing without that. The point here is to chase that 1%, 2%, 5% if you're really ambitious, okay, is by putting a percentage next to each one of your costs. We talked about having 3 cost buckets. COGS, your cost of goods sold, labor, all the costs of your wages and everything associated with your employees. And the third one was overheads. 3 lines. Start there and put a percentage next to each one of those. The way you do that is you take the total COGS and you divide that by your total revenue. A lot of restaurants want to target 20 to 30% food costs, okay? So that if you are on the most efficient side and you're at the 20% number, all right, 20% of $1 million means $200,000. If you're going over $200,000, then you've got some work to do. You can do that by changing where you're buying your food. You can change that by increasing your prices a little bit, as long as people still find value in your food. There's many different ways, and we'll keep getting deeper and deeper into these in more episodes that come up. A lot of restaurants are kind of averaging somewhere between 20 and 30% in their overheads. Depends if you're including your rent, depends kind of where you're located, and so on, okay? And if you're there, and we said we were 65, and then you add another 25% or 30%, you're at 95 now, that's your 5% left for your profits, okay? Now you know what they are and what your goals should be, and that should be if you're seeing, oh my God, why is he talking about 20% food costs? I'm at 35. Okay, you don't be upset. See it as an opportunity. There, you should understand from an industry standard, you have got waste somewhere, and that should be some easy, low-hanging fruit, cherry picking experience for you. Go find where it is, get help if you need it, call some friends, send me questions. Let's find out where that excess 5-10% is. We can get you right on track real quick. Now, once you get that to the best it can be, go to the next thing you know best. Is it people? Is it labor? Is it overhead? Yeah, renegotiate your subscriptions, renegotiate your rent if you can. Maybe you're in a 10-year contract, you can't. Find the things that can. It sucks, it's annoying. You've got to get in front of people, suppliers, and renegotiate, and you can do it. You might need to get little things to save you pennies and dollars here and there, and those things add up. Like getting, water saving measures, getting kind of figuring out ways to use your space more days, sublease it, rent it out on the weekends for different events. I don't know. Everyone has opportunities, and those are the ways you reduce that. Okay, you increase your income or you reduce your costs, and that's how that percentage changes. For those who are like, oh man, that's not enough. 3 buckets, it's not enough. I need more line items. You're right. If you're saying that, if you're thinking that, I love you. Okay, you get it. You get it. You're like, I don't want to just know what my food cost is and put everything in one bucket. No, I want to know what my food costs are and what my beverage costs are. Already you're splitting that into 2. And then maybe you're saying, I want to know, you want to break it down by like poultries and meats and cheeses or desserts or different kind of menu items, different categories. You can keep breaking that down and down to finer and finer, but don't go crazy, because if you get too many, you can't manage so many lines. You want to keep it simple. You ever heard of KISS? Keep it simple, stupid? Keep it simple, stupid. And when you get smart, then keep it simple for that level, okay? And then you're graduating, ready to do more and more. Your labor, you can divide your labor as well. Okay, you can start with wages as one line, salaries as another line, and then all other kind of labor costs in a third line. That's maybe one of the simplest kind of next thing to graduate to. Another line after that, like in our company, what we do, we have a training line. We don't see people training as people doing the work. We see that as excess. So we don't want to, when comparing month to month, say, in February, were we training 4 people? But then in March, we were only training 2, and that's why our expenses went way up, and we have to like sit there and remember what we did. No, we just decided, hey, you know what, let's take training out, put it in a separate line, and that way I know I always have like 5 servers on my Thursday night, and I still have 5 servers on my Thursday night the next month as well. Makes it easy to compare and see if I'm making improvements or not. Overheads is probably one of the easiest places to split out lines because there's so many. I mean, right away, the big categories would be things like services and subscriptions, okay? Then the next one would be your occupancy costs. Occupancy is anything associated with where you are renting. If you are not renting and happen to be in the fortunate position of owning where you are, put a number there. Pay yourself rent. Pay yourself as the landlord some rent, and on that P&L, have it in there. Call it $2,000 a month or $20,000 a month. I don't know how big your space is, but put a number there and pay yourself as a landlord. And understand that that's an expense, because if you don't, then your business is going to look like it's making 5%, and you're like, yeah, I make 5% just like everyone else. Well, no, you're really kind of making like 3% because you're not really calculating rent. See how that works? Same reason why you should pay yourself in that P&L. Now, a few other buckets you could do in your overheads would be marketing, very common line, very important one. I mean, we could talk days about marketing, how much you should spend on marketing, and what good marketing is versus bad, how to measure marketing, that's a whole other thing. I hate trying to measure marketing. Unless you have like redeemable coupons, how do you know? You gotta believe, okay? You gotta really understand that that is your message and how you wanna communicate with your guests. Another line item I like to consider in my overheads is repairs and maintenance. That thing can get out of control. And you know what? Sometimes you gotta do it. Your AC breaks and you spend $5,000 fixing it, guess what? You shouldn't feel bad that month. It sucks, but someday, somewhere, somehow, everyone's AC breaks and they gotta fix it. What you don't want is to think that you had your worst month ever because you had a major repair and weren't really tracking it. It's so easy when you start doing your monthly P&Ls, maybe bi-weekly, maybe every week, you wanna start to really understand and hone. To understand 1 month when you made $5,000 less than the month before, you're like, what did I do? I was tracking everyone. I was making cuts early. I was watching my food costs. Oh, there it is. Maintenance and repairs, $5,000. What was that? Oh, the AC, remember that? Yeah, you didn't have that the last 3 months. So of course you're gonna have a worse month. And you gotta try to make it up in another month. Let me give you an example of why managing by just your bank account is a terrible idea. Let's say you just made payroll, all right? And let's say you pay your employees on Monday, okay? And it's the end of the month comes around, the 31st is a Tuesday, and you're like, hey, let's see how we did this month. And you pull up your bank report, okay, and you look, and you're like, $500, $500, what? I thought I did good. I remember I had that big dinner party that came in. Yeah, of course. You just made payroll yesterday. course you're gonna have very little. The opposite is true too. Let's say that the end of the month happened to be Sunday, okay, right before that Monday where you paid $20,000 in wages and payroll. And you're like, oh my God, look at this, $20,000, 500, I'm rich, what a great month, honey, let's book that vacation. No, payroll's tomorrow. Payroll's tomorrow. You just spent $20,000. You don't know if you made money or not that week. You know why? Because the way your cash flows in and out has nothing to do with whether you made profits that month or not. We gotta understand the difference between profits and cash. That we'll talk in another episode.